Good morning. Welcome to Thursday's edition of Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar, and with me is Vivek, and the markets are holding up in the green. We're off from the session highs, but we're also off from the lows. We're trading somewhere in the middle of today's trading range, which is 22,500 to 22,250. The Nifty up close to about 0.2%. We woke up to a lot of global cues. So in that context, it's a bit disappointing that the morning, gains are not being held on to. We've seen crude prices down. Dollar index is down to 104.5. In fact, 104.3 now. Right. The last time I checked, oil and gas, like stocks like Reliance, has seen an upgrade. The global cues are positive because tariff exemptions for auto at least have been provided for 1 month. So there are lots of global cues. But despite that, the markets could not hold on to their morning gains. But this week, it's been a good week for us so far, with the Nifty up close to about 1%, the Midcap index up nearly 3.5%, and this Midcap outperformance continues even today. The Midcap index is up 0.6%. Advanced decline ratio stands at 6 stocks advancing for 1 in the red. The big gainers include oil and gas. The Nifty oil and gas index is up 1.5%, but you also have, gains in other PSUs, metals, and on the way down, you have some softness visible in auto. In fact, that's the only sector which is in the red right now. That's right.
Good morning, Reema. Like you mentioned, some positive cues coming in overnight. First up, has to be the fall as far as the crude oil prices are concerned. The back of that, like you mentioned, the oil and gas pack is doing quite well. And it's the OMCs, the ones that see significant higher marketing margins. They are the ones that are doing so much better in the session. And IOCL, HPCL, BPCL, HPCL, the top gainer within that particular pack. On the other side, the crude sensitives, a whole host of FMCG stocks, that have derivatives of crude as their input prices, they are the ones that have seen significant buying. So names like Pidilite, Asian Paints, Berger Paints, all of these stocks today seeing significant buying. Now, on the other hand, Castrol India, some news reports indicating that, there could be a bit coming from Saudi Aramco as far as the lubricant asset sale is concerned. And on the back of that, Castrol India, one of the top gainers, in fact, the NSE 500 top gainer. So that particular stock, Reema, is doing very well in the session.
Okay, let's get the show started then with some of the big stories that we're tracking. And sources tell CNBC-TV18 the U.S. government has sought zero tariffs on almost all products traded between India and U.S. Parikshit joins in with the details. Parikshit.
Well, yes, this indeed is an important development. U.S. and India have initiated formal talks on a trade agreement this week. And we believe that U.S. has started the talks by seeking zero tariffs across product lines, except for the agricultural sector. Remember, Donald Trump has also said that he will be imposing tariffs on agricultural imports into the United States. For the moment, they're saying that there has to be a zero to zero tariff policy between India and US. And this would, of course, apply to cars like Tesla and the automobile sector as well. What is India going to do? India has offered greater market access for US industrial goods into India. They've also sought greater access for Indian MSME products made by high labor-intensive sectors in India. But these are the first round of talks that have taken place. Both sides will now go back and deliberate on the proposals. India is going to think about these proposals. But definitely, there would be concerns about a zero tariff policy. Reciprocal tariffs, that threat, of course, looms large. And India would be hoping to strike some sort of deal with the US. But for the moment, any kind of carve-out for India looks difficult.
Thank you very much for that. One of the other movers of the day in the mid-cap space is Route Mobile. And the company's promoter, that's Proximus Global, has entered into a partnership with Nokia. Nokia is a brand we're all familiar with. They will be providing certain network APIs to help developers create enterprise applications for companies. Now, they're looking to create new applications in the areas of financial services and healthcare. The stock is now up close to about 4%, and the move also follows a very sharp decline seen in the stock price. The stock is down 45% from its 52-week high. It's gone through a period of slowdown. The global macro uncertainty has slowed the company's growth, and now the company is talking about a 15% revenue CAGR over the next 3 years. So today, the stock is higher on the back of this partnership with Nokia. Details of the partnership are not known.
Thank you so much, Reema, for talking to us about Route Mobile. Stock up over 4%, like you mentioned. Well, the other stock that's doing quite well is the stock that has a significant weight as far as Nifty is concerned, and that's Reliance. It's gaining on the back of multiple brokerage notes. Sudarshan is here with more details.
So today we have two positive brokerage notes on Reliance Industries. One is Kotak and another is from Jefferies. Both Kotak and Jefferies have buy call on the stock, and Kotak expects an upside of nearly 16%, while Jefferies expects an upside of nearly 30% from current levels. So what does Kotak say? It says that first it has upgraded the stock to buy. It says after the recent correction, risk reward is favorable. And what were the reasons for underperformance? Reasons are the same by both Kotak and Jefferies. First one is subdued retail business performance, and second, that is weak refining outlook. Now, what is the outlook that Kotak expects? It says it has cut FY26 and 27 EBITDA estimates by 1 to 3%, but despite this cut, it expects earnings CAGR of 11% over FY24-27. So as per Kotak, what would be the catalysts? First, retail business will likely improve in next few quarters. And second, Jio Platforms IPO timeline and likely any tariff hike will be two major catalysts for Reliance Industries going forward. Now coming to Jefferies, it has a buy call with a target of 1600 per share. It says pessimism seems over extreme and current market cap implies $48 billion EV for retail business versus $106 billion in last funding round. As per Jefferies too, recent underperformance was because of slowdown retail and subdued O2C earnings. Now, as per Jefferies' outlook is store sales growth and area addition should restore 15% growth for retail business in FY26, and also tariff hike, likely listing of Jio and improvement in O2C business will be likely catalyst going forward for Reliance Industries. So both Kotak and Jefferies are positive on Reliance Industries.
Thank you so much, Sudarshan, for talking to us about Reliance Industries. But Sudarshan, the other pocket of the market that's doing very well are actually the oil marketing companies. So ISCL, BPCL, HPCL, even as we speak, trading near the day's highest points. What are the brokerage views on these names?
So first, over the last 2 to 3 days, all these three names, IOC, BPCL and HPCL, have been gaining. But take a look at the stock performance. BPCL is down 30% from its 52-week high. HPCL is down 26% and IOC is down 33%. So what are the positive catalysts? First one is the sharp fall in crude that we have seen in the last 3 days. Now Brent is back below $70 per barrel, which is at lowest levels in 6 months. Now why this fall that we have seen in the crude? Because OPEC Plus has decided to increase the production. Basically, it has reversed its earlier decision to cut the production. Now, because of that, there has been a sharp fall in crude, and that is one of the major catalysts. And second is, remember in the last month in the interview with CNBC-TV18, Oil Minister did say that LPG compensation for all OMCs will come, because it was not announced in the budget, but after that Oil Minister had come on the channel, it said the LPG compensation will come. That can also be one of the major catalysts. But what is one major risk? Because if you remember, till few months ago, these companies used to get Russian crude at a higher discount. Now the discount has narrowed, so this can be one of the major risks. Now coming to the valuations, HPCL is currently trading at 1.1 times FY27 price to book value versus historical average of 1 time. BPCL similarly at 1.1 times FY27 price to book value versus average of 1.4, and IOC as 0.8 times versus average of 0.9. So even on the valuations front, most of these companies are trading near or below their average week. So here also there is a room that there might be a further upside for all these three companies.
Okay, valuations also supportive, and so is the macro backdrop. Thank you, Sudarshan, for explaining all sides of the story about oil marketing companies. Get into a break. On the other side, we discuss commodities with Manisha Gupta.
Welcome back to Trading Hour. Well, let's now shift focus to the commodity space. Manisha joins in, and today you're focusing on silver, right?
Yes, I am, Vivek, and you know, the kind of run-up that we've seen in many of these base metal prices in last 24 hours definitely has had a spillover effect on silver as well, which is part industrial metal and part precious metal. So we have seen silver actually take gains from both of these sides. Some safe haven buying, of course, has continued, and we've seen silver prices continue to hold above that $32.5 per ounce mark. Well, to begin with, it has to do also with the decline in US dollar index that has been supportive, and most importantly, US putting that 25% tariff on Mexico is something that the street will watch out for. If you look at the silver prices, we've gained up by 4% on a weekly basis and 13% now in this year already. So Mexico is important when it comes to silver. Almost 25% of global silver production does come in from Mexico. We have the major mines in Mexico as well. And with this 25% tariff that has been put on Mexico, that would make silver expensive for US buyers coming in from Mexico, but not so expensive for the rest of the world. So that really means a bit of an arbitrage and disruption in the markets that as we would see. As of now, all of us look at gold and silver prices coming in from COMEX, but there could be bigger premiums and discounts in the global markets going forward because of that. The other reason that you have seen silver prices gain up is that this is a fifth straight year, 2025 that is, which is going to be a deficit year in the global markets. And when you look at the industrial demand coming in, 700 million ounces of a demand expectation for this year also is a record number. So that in turn also is supportive for silver. There have been various reports from UBS, Bank of America, Goldman Sachs, etc., which are putting silver price forecast anywhere between $35 to $38 an ounce in this year by the end of this year. That is, currently we are trading at 32.5. The most important thing to watch out for is going to be the US non-farm payroll data tomorrow. For a near-term reaction, that is what the street will watch out for.
Thank you very much, Manisha, for putting the spotlight on silver. Get into break. As we do that, here is a small programming note for all our viewers. CNBC TV18, HSBC India are back with Season 2 SME Champion Awards. The prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code. Submit your entry for the SME Champion Awards Season 2. Welcome back. The Nifty Bank is completely flattened out right now. It was holding up with marginal gains, but that's been given up. And HDFC Bank has been a bit of a problem for our markets. HDFC Bank is down close to about 0.7 of a percentage point. And this week, HDFC Bank is down nearly 3%, underperforming the banks, the other banks, and even the benchmark index. Kotak Mahindra Bank, too, has a red tick. Jay Thakkar from ICICI Securities is now with us on the show. Jay, what's the setup looking like? You not managed to conquer that 22,500 mark. So is that a bit disappointing to your mind?
Good morning to you, Rima. Well, say, Rima, today we have this weekly expiry of the Nifty, and we have seen that 22,500 to 22,600 strikes have seen good amount of call open interest addition, and because of which Nifty is struggling to move beyond those levels. I think eventually, once this weekly expiry is over, until next weekly expiry, the probability of Nifty inching towards 22,800 is quite high. I believe that on the downside, 22,000 to 21,800 range will now act as a very crucial support. There are multiple factors for that. I would say the first is that the India VIX is now stabilized. Now it's not moving much higher beyond 15, 16, and it has stabilized in the range of 12, 13. That's the first sign. Second is we have been seeing some short covering, so there's a FI addition on the short side now. The short covering is most likely from here on. We have seen the dollar index coming down, the crude oil prices coming down, which will eventually support the market bouncing back from the current levels. And the final thing would be in favor of markets would be on the on negative news as well, when the CBOE VIX in US rise by almost for the 2 consecutive days until 25.5, 26 levels. Despite that, we did not see Nifty breaking 21,800 to 22,000 levels. Because of these reasons, the probability of 22,800 is more higher. But then that would be until next weekly expiry. Today, the expiry would be most likely between 22,200 to 22,500 range. So, for the short-term positive outlook, Rima, I have a couple of buy recommendations. The first one is on ABB. We have seen record high futures short OI as far as ABB is concerned, and we have seen the technical breakout as well. So ABB is likely to witness the short covering. The stock is trading around the levels of 5,300. I think it's likely to inch towards 5,500 to 5,600 in this short covering process. And on the downside, one can place a stop loss below the levels of 5,180. There's a good risk reward on the long side. Second buy recommendation, Rima, would be a contra bet on Reliance, the big boy. I would say that I'm presuming that the probability of a short covering on this stock is also quite high. Until 1150 levels are now held, the stock is likely to bounce back until the levels of 1260 to 1280 levels. The risk reward is positive out here as well. And our final buy recommendation, Rima, would be on from the banking side, Federal Bank. We have already seen short covering happening in this stock. The prices have not reacted much. It's already showing a good positive momentum bias. So stock is trading around the levels of 181. I think Federal Bank can also witness the levels of 188 to 192 in days to come. One can place a stop loss below 178 on a closing basis and go long on Federal Bank as well. So I'm expecting a positive bounce back in Nifty at least until next weekly expiry, till 21,800 to 22,000 levels are held.
Thank you so much, Jay, for joining us, giving us a view on the markets, your expectations for the levels as far as expiry is concerned, as well as your individual picks. Well, moving on, Credit Access Grameen is buzzing, and this on the back of an operational update that the company has given as far as the month of February is concerned. Abhishek is here with more details.
Well, in a surprise move, Credit Access Grameen has given their business update up to the month of February. So loan book over there has grown by 2.5% from the number that they had reported in December of 24 or Q3 FY25, wherein the Karnataka loan growth over the last 2 months has been around 1%, while other states' loan growth is around 3%. Now, PAR, that is portfolio at risk, between 0 days to 60 days of overdue has increased to 12.9 versus 11.9%. PAR 60 plus days has increased to 4.3 versus 3.8, and PAR 90 has increased to 3.4 versus 2.6% that they had recorded in December 24. So from December 24 to Feb 25, Karnataka over there, the PAR 0 has increased to 7.9 versus 4.3, and PAR 90 has increased to 2.1 versus 1.2%. Even for Tamil Nadu, the PAR 0 has increased to 9.3 versus 8.9, and PAR 90 has increased to 4.5 versus 3.2%. Bihar over there, the PAR 0 plus has actually declined to 14% versus 14.8% as of December 24, and PAR 90 has increased to 7.6% versus 5.3%. So overall, the portfolio at risk of overdue of more than 0 days has increased to 7.5% versus 6.8%, and portfolio at risk more than 90 days has increased to 3.4% from 2.6% that they had recorded in December 24. So what they mentioned that over the last 2 months they have seen new borrowers addition of nearly 1.5 lakh. In Karnataka, they expect the situation to gradually normalize in the next 1 or 2 months. So a definite timeline with respect to Karnataka is being given with respect to situation normalizing. Back to you.
Thank you very much for that important update. The stock has gained 7.5%. Get into a break. On the other side, we'll discuss market fundamentals. Ashi Anand from IME Capital joins in next.
Welcome back to Trading Hour. Well, as promised, Ashi Anand, CEO and founder at IME Capital, joins us now to discuss market fundamentals as well as the top sectoral picks. Thanks so much for joining us, Ashi. First up, from the last time you connected with us, there's been a significant change as far as valuations are concerned, and valuations now are a lot cheaper. Have you started deploying capital, and which are the sectors or names that you like at the current levels?
Hi, sure. Thank you. First of all, thanks so much for having me on the show. So yes, valuations have kind of corrected, but I think it's also just important to understand the extent of valuation correction in the context of the larger kind of move. So if you're looking at kind of from pre-COVID levels, right? So we're not taking from the COVID low. You have kind of large caps having moved up about 120%, the BSE 500 up about 160%, and small caps up about 300%. Now, if you're looking at the correction in large caps are just a little over 10%, BSE 500 at about 15% and 20% for small caps. It's not necessarily that valuations have corrected enough to make markets cheap or really attractive. Also, in the context of the kind of various headwinds that you are seeing in terms of slowdown in overall economic growth and corporate earnings, uncertainty around Trump, FI outflows, etc., we do kind of believe that markets may remain a bit more muted in the near term. And accordingly, we are being a bit slow in terms of deploying some of our capital. An important element is we are starting to see certain green shoots. GDP has recovered in the third quarter. You are seeing oil prices having fallen. And also importantly, Trump has backed down a bit in terms of tariff aggression. So it is going to be a market which is going to be a bit kind of muted and volatile in our view, and we will accordingly be looking at kind of deploying capital accordingly. In terms of the specific kind of sectors and segments that we are effectively looking at deploying, or the places that we are finding more attractive at this point in time, I think banks clearly, and banks across different segments, right? Be it the high quality franchises, which are available at much cheaper valuations than they have been historically. Or if you're kind of looking at kind of banks with MFI exposures, which have corrected quite significantly, there are a lot of interesting opportunities out there. We continue to like digital from a longer term perspective. These are kind of probably the two major kind of sectors we're really focusing on. But the other kind of important element is that as capex, real estate, defense, and capital market kind of companies are correcting, these are all segments with a lot of business momentum that we find quite attractive from a longer term perspective. If these kind of correct more, we may actually look at kind of deploying some additional capital there.
Okay. Do you want to elaborate a little bit more? You spoke about slow capital deployment. How much should one be deploying, and what is the near-term outlook? Like deploy every week, or do you think there is going to be another impending correction? And then a little more detail about the stocks that you're investing in.
So the main point is that we have about kind of 6 to 7% cash across both of our portfolios. It's not so much the pace of when we're deploying, we're really kind of looking at kind of news flow and seeing how news flow evolves. An important element is kind of some kind of clarity around how Trump and kind of tariffs, how is this actually going to settle, right? Right now, there's just a lot of noise. It's a lot of posturing. You really need to understand where that kind of settles. I think that's one important element. We are closely kind of monitoring what's happening in terms of growth across different segments. You have seen a kind of growth slowdown, but you are also seeing some segments where growth is coming back. So I think more than specific time, we're really waiting for certain kind of news flow to actually emerge. And as you get some clarity around both growth, interest rates, and kind of geopolitical related to tariffs, that's kind of when we will get a little more comfortable deploying more aggressively. I'd rather not talk about, especially from a capital deployment, kind of specific stock names, because obviously these are companies that we are looking at possibly investing in, and we can't, from a compliance perspective, speak specific stocks. But broadly, in terms of kind of segments that we are actively kind of looking at, those are kind of banks, listed digital platforms. We are also kind of monitoring certain consumer and IT companies that we find attractive. And capital goods, real estate, capital markets, if some of these companies correct more, we'll clearly be looking at deploying some more capital there.
Thank you so much, Ashi, for joining us, giving us a sense of how you're looking at markets at the current junction and which are the sectors that are looking attractive to you. Well, moving on, time now for a short break. Pawan Goel from Naukri.com joins us next to discuss the latest trends in hiring and the job market.
Welcome back. Naukri.com recently released their JobSpeak Index for the month of February. And the job market is looking good. On a year-on-year basis, we saw the JobSpeak Index rise by 4%. On a month-on-month basis, it was a growth of more than 13%. The key drivers of growth this time were hospitality and real estate. And that's emerged as a fresh hiring hotspot. To discuss this, we have Pawan Goel, Chief Business Officer at Naukri.com, joining us on the show now. Pawan, thank you very much. Enjoy these monthly chats with you about the state of the job market in India. So first, tell us the key trends that have emerged in the month of February and the key divergences from the trends seen in the past.
Yeah, so I think if I look at February compared to last year, Jan and February were year-on-year degrowth last year. So this, in that sense, January and February, though they are muted in JobSpeak growth, they started off on a positive note. As you correctly called out, hospitality, real estate are the growth drivers. IT is flat. So what we have seen is previously Indian job growth was a lot dependent on IT. So while IT still remains a contributor, the growth is becoming more secular in terms of industry as well as geography. From a geographical standpoint, the growth is led by non-metro cities such as Bhubaneswar, Udaipur, Coimbatore, Raipur. Now, if from a state lens, when you take, it's Madhya Pradesh, Odisha, Chhattisgarh. They stand out as the growth states. Now, granted, they are smaller in their base, but growth is substantial there. Now,
sorry, go ahead. No, please go ahead. Complete.
Yeah. One of the other trends that we see is while there, so let's say in retail, okay, while retail is facing headwinds, consumer durables and other segments like garment and accessory, beauty and wellness and retail, they are doing well. So it's not a one story that fits across all sectors. It's very sectoral specific nuance. There are sectors that are doing well, sectors that are sort of moderate, sectors that are slowing down. So it's a very, not a one story that goes across.
Got that. This hospitality, the big jump that we've seen this time, 20% year-on-year revenue growth, is it linked to Mahakumbh? Is it sustainable?
Don't know whether it is linked to Mahakumbh. I'm sure that has probably contributed. But if you take a longer view, travel, tourism, hospitality has been a growth sector for a while. So there was a temporary slowdown, but it has been growing for a long period. And from whatever we see, we believe that this is actually a trend that is here to stay.
And this IT, you said IT was flat. Even the prior quarter was flat. And I think in the last 4 months, in 3 of them, we've seen a flat or a slight degrowth in IT services. So has there been a pause in IT hiring?
So again, it's a mixed story. So if you look at IT biggies, as you know, their net headcount addition is fairly muted. But if you look at GCCs and specifically new GCCs, that's where the growth is. Now, if you look at our GCC index, that also is flattish. And that may lead to wonder saying, hey, while the story is that GCCs are growing, why does our job index show as flattish? So what our job index captures is not just the new incremental hiring, but it is sort of the total hiring momentum there. So which includes attrition. So the GCC biggies are not growing, but a lot of new GCC activities that we are seeing. So if you look at new GCC hiring, that is growing. But overall, if you look at since the existing IT and existing big GCCs, which are exposed to PFSI, their growth is muted or the attrition rates are there low. That's what reflects in a slowdown in the jobs peak trends.
So GCC index this time is flat in the month of February, year on year.
Yes, it is flat.
And what would have been the, say 6 months back, you know, what was the growth what was the growth and any particular reason why the big existing GCCs have paused their hiring?
So take Barclays, take many of the others, BFSI exposed GCCs. They have slowed down and they have a substantial base in India. And BFSI may be facing pressures globally, and that's what probably is reflected here. But if you look at new GCC activity, that's clearly on the rise.
Thank you so much, Pawan, for joining us, giving us a sense of how exactly hiring trends are panned out as far as the month gone by is concerned, and a few trends to look forward to as far as the coming months are concerned. Well, time now for a short break. We'll get you more on the markets on the other side. Welcome back to Trading Hour. Well, even as we speak, all of the indices are now firmly in the green. Even the Bank Nifty that at one point of time had slipped below the flat line has once again recovered and now trading with a slight gain of 0.15%. Which are the stocks that are doing very well? Well, the entire NSE FMCG pack. So all of the FMCG names today are doing very well. Some of the names include names like Godrej Consumer, that is GCPL. Look at Marico, that particular stock is doing very well. HUL, all of these stocks, are, you could call them crude sensitives, they are doing very well. And the actual crude sensitives, which are the OMCs, that are the other set of stocks that are flying away, and they continue to remain among the top gainers as far as the F&O space is concerned. So names like HPCL, BPCL, IOCL. So overall, Rima, falling crude oil prices bodes quite well as far as quite a few pockets of the Indian markets are concerned.
Indeed, Asian Paints, etc. Top Nifty gainers right now. For the markets, we're at 22,400 exactly, a gain of about 68 points. So decent day so far. There has been a recovery from the day's low. We're going to wrap up on Trading Hour from the entire team. Thank you for watching.